With the recent crisis around the coronavirus, there's come some big questions about the foreign exchange markets. Where are the winners and losers going to come out through from this crisis when it's over? We know that there's going to be a big global economic hit from this, but does that sink all foreign exchange boats? What happens to the dollar? Let's get a technical viewpoint now from Ron William from RW Advisory, who joins us on a Skype call. Ron, good to talk to you, and I hope you're keeping well. Let me ask first of all about COVID-19 and the FX markets. What's your global view of the foreign exchange as it stands at the moment?
Well, certainly it's been affected with this reawakening of volatility, and we're seeing that across the board on euro-dollar, but also other rates like the yen. And it was partly, of course, due to the COVID-19 shock, which later on led to actual forced liquidation of some risk unwinding. And that's what we see on the euro-dollar chart, where we have this 8 big figure swing in just a week or so. So really kind of big gyrations in the market. And from a behavioral technical analysis point of view, this is an emotional footprint of a high magnitude that is really telling us a key message here. And that message, I believe so far, is reinforcing the downtrend for euro-dollar into parity.
Okay, keeping this chart up, I just want to refer to the bottom box. I think it's worth looking at this volatility indicator here. And also the point that you're making here, bearing in mind the Bollinger Bands that you put on the main price action chart. How do you just illustrate this in some more detail?
Yes, so this Bollinger Bands and counter bands, it's a volatility breakout system when you use the two together. But essentially, it's a measure of volatility. And when the bands actually squeeze, that gives you an early signal that the squeeze action will lead to a reaction of some kind of explosive move in the market. And that's what we saw early in Q1 February. It also coincided with the timing cycle there on the bottom axis. You can see there Q1 Feb March, the same cycle, which was actually more precise for the equity market and led to my short position on the S&P 500, also was very relevant to the currency market and euro-dollar. You can see there for the extent of that entire cycle highlighted in blue just below, and then the yellow box overlaying, that was the entirety of the price swing. Now, if we look at the lower indicator that you refer to, that's Bollinger Band width. That's measuring the distance of the Bollinger Band. So when the indicator expands and squeezes, that's what we're seeing on the screen there. And you can see there for almost a year, we had a long-term calm environment. That's the action stage 1, then leading to the reaction stage 2 of the big breakout. So it's this calm before the storm, yin-yang kind of duality to volatility that we should really adapt to in fast-moving markets. And just to highlight, the key level at the moment on euro-dollar is 106.40. That's on the low side, and the highest level 115. If we break above 115 or 112.30 before that, and then 110.90 on the probability distribution levels, these are upside risk levels that will neutralize the bearish stance that I have on the chart. But right now, 106.40 is the key level to break below.
Okay, let's shift on and take a look at a slightly longer term picture, because I know that the 2-year picture is of interest when looking at the long term or the longer term trend that's been set in place.
Yes, well, a big picture analysis is key to how I look at the markets, and especially during fast-moving markets like the one that we're in. And it really gives that forest from the trees perspective. And we can see here that volatility signature, 8 big figures up and down in just 1 week, reinforced this 2-year trend, which is still, of course, looking bearish for moves into the level I mentioned before at 106.40, that's the prior swing low, but actually further down, 103.50, which is a 14-year low. And this is really key across all the remaining charts that we look at in this interview. Interesting note to just show that the volatility signal remains strong there as well. When we look at the higher time frame, we can see long-term environment action leading to the higher volatility reaction.
As we move on to the next chart worth looking at is the chart where we take in an even longer term picture. And I mentioned the volatility in that second chart because I think it's worth looking at it in this third chart as well. But explain how this all works, bearing in mind we've seen this recent rise in volatility, but it doesn't seem to be on this far longer term chart.
Yes, so time and price is all relative to the scale that you're looking at. So we think about the domino effect or the anecdotal Russian doll experiment where you start with a small model and then upscale through the system. That's what we're seeing now. So on the high time frame, what looks like a big volatility move is actually relatively smaller than we think it is. So it's almost like sitting in a small speedboat. It feels maybe a decent experience at the time, but until we actually see a big oil tanker just right in front of us, and then we feel relatively smaller to what we're looking at. And it's the same thing here on euro-dollar volatility on a long-term basis, multi-year basis. It's actually at historic lows on a long-term basis based on the Bollinger Band width. It may be different on other volatility measures, but what it does show is that we're likely to have an even bigger vol move likely this year or thereafter. And certainly the price chart shows that the trend is still pushing down, not just on the 2-year trend, but actually a larger 12-year trend. So real kind of Newton's law of motion really driving lower and pressuring that market further. Despite all of the macro and event risk that is at play, it really is the perfect storm for a euro-dollar downside move. And it's just to highlight that the 14-year low at 103.50 is part of a multi-year congestion zone. So it's kind of more of the same, and it would really unlock that entire trading range from before and trigger a very fast move into parity, but actually beyond parity as well. So let's be prepared for big moves with big vol into parity and beyond, potentially with a risk to 0.9890 and lower. And so this chart is really going to be key, I think, for the coming months. Whether you're trading on the intraday basis or higher timeframes, there really is no excuse. We need to be looking at the big picture charts just to mitigate risk and to maybe look for some of those trading opportunities.
Is it possible to put any date stamp on this? It's obviously difficult in terms of precise days, but are you giving any sort of projection as to when we could possibly see parity and the journey between where we are now and the parity strike?
So in terms of what we've seen, high volatility is likely to stay. That's what the probabilities suggest. There are no certainties in predicting exact price or time moves. But certainly, point number one, we're already in this new volatility reawakening, and the charts in terms of the technicals, but also the actual volatility indicators suggest that there is big vol yet to come. Now, based on the cycles that I'm looking at for the rest of this year, summer looks like a kind of a heated period of the year where we are going to get an echo shock in the market, which will likely, of course, hit the equity markets hard in that third downswing on the equity market as part of that three-stage move we spoke about last time. And on the currency market, of course, that could lead to further risk-off plays on euro-dollar, which is used as a risk proxy, and potential forced liquidation for any players out there that get hit by margin calls. And maybe during that time, I think looking at the COVID situation will be key, separate from the technical view, because of course any escalation will just add further pressure, from a market perspective and just general.
And as we go into your last chart, having mentioned the parity level, I think it's worth looking at what you call crisis pattern signatures. Explain more about this.
Yes, so patterns exist in life and in markets, and often in markets, and it's a historical rhyme. Doesn't necessarily mean that history repeats technically or even macro or in any other way, but it is a pattern rhyme in price and time terms. And so very interestingly, we have this mirroring pattern on Eurodollar going back to the Deutschmark years, believe it or not. So history does have this emotional signature to it in terms of crowd psychology. And what we see here is a two-stage pattern. During the risk-on cycle years, on Eurodollar, that's reflected as an up move of, on average, 91 to 93 months. A strong uptrend of 91 to 93 months during the risk-on cycle periods. But then linear moves don't last forever. They eventually peak out, and it's the peaking out of this risk-on cycle which is marked by crisis events, hence the crisis pattern signature. So early on, it was the ERM crisis of 1992, that far back. And then fast track to the next time we had this pattern repeat, it was the global financial crisis of 2008. So that's, of course, 12 years from where we are now, but the corrective pattern is still in play as it was post 1992. So we're having this mirroring effect of a risk-off period continuing on a very long-term basis, and that is targeting parity, which on this chart, if you go back as far as 1985 to actually plot the historic lows, it shows a 30-plus year uptrend, which is actually a long-term downtrend target on Eurodollar. And just looking at the bottom part of the chart, you can see there's a long-term cycles at play, 16-year cycles and 45-year cycles as well.
And also on this chart, on the far left-hand side, you illustrate quite neatly this idea of this black swan event. Of course, 4 or 5 months ago, we had no idea what was going to hit the markets, what was going to hit the global economy. And here we are now, 3 or 4 weeks into a global lockdown for what is, at the moment at least, the ultimate black swan crisis. But how do black swan crises develop?
They're the unknown unknowns, as some theorists say. And actually, Nassim Taleb is quite the expert on this and has published on the subject, and actually suggests hedging a small part of the equity on potential black swan events on the off chance that markets flip the other way. And so that's why some funds have actually done well this year, because they did put some risk capital aside just in case. And so one of the things I think that technical analysis really helps with in terms of high sigma volatility events and black swan events is actually through scenario analysis, being prepared for what we're not prepared for, being prepared for the unknown unknowns, just by looking at the two-sided nature of the market and putting volatility at the heart of that analysis. And so what I've done here on that small insert on the left-hand side is just anecdotally think of some technical or macro or socioeconomic black swan events that can take place on the left side of the tail of the probability distribution. And so these are black swans, known unknowns and unknown unknowns. The pandemic escalation is the most known unknown. And of course, that can get worse before it gets better. And then, of course, thereafter, we have an economic crisis kind of risk, very much in the Euroland, which is why I put it here, where Italy, for example, and Spain, although they're in their peak stages, the ramifications of that kind of peak impact of COVID-19 has yet to be priced in. And so that could lead to Euroland economic crisis, but also social instability, a risk to keep in mind, and various other things that we can maybe add to that black swan curve, just as a macro driver, known unknowns and unknown unknowns ahead.
Okay, look, Ron, we'll leave it there, but thank you very much indeed for joining us with a look there at the potential for parity for the euro dollar. That's Ron William from RW Advisory.